There's a very common experience in technical analysis that I think many traders have had. You learn a candlestick pattern, let's say the hammer or the shooting star. You understand what it looks like. You understand what it's supposed to signal. You put it on a live chart. You see the pattern form. You take the trade, and it doesn't work. So you conclude one of two things. Either the pattern is unreliable or you're doing something wrong. And most of the time, neither of those conclusions is quite right. The issue isn't the pattern, and it isn't the trader. The issue is structural. It stems from a specific misunderstanding about what candlestick patterns are designed to do and the role they're supposed to play within a larger analytical framework. I've been using candlestick patterns in my own trading since 2007. They're part of how I read charts every single week. But the way I use them looks very different from how most traders first learn to use them. And that difference in framing is exactly what this video is about. I'm going to walk through what the pattern as signal approach is trying to do, why it breaks down in practice, how I think about these patterns, and what the correct framing looks like, especially for position trading on higher time frames. This is about correcting a structural misunderstanding, not about finding better patterns. The logic behind trading candlestick patterns as direct signals is straightforward and honestly quite reasonable on the surface. The idea goes something like this. A hammer at the bottom of a sell-off tells you that sellers pushed price lower during that session, but buyers came back and pushed it back up before the close. That long lower shadow is evidence of rejection. Sellers tried to extend the move, but failed. So the pattern signals a bullish reversal and you buy. And the same logic applies in reverse for a shooting star at the top of a rally. Buyers pushed price higher during the session, but sellers came back and drove it down to close near the lows. That long upper shadow is evidence that the push higher was rejected. So you sell. It's clean, it's visual, it's grounded in a real reading of what the candle is showing you about buyer and seller behavior, and it connects to something intuitive. That price rejection at an extreme is a meaningful signal about where the market might go next. There's also a satisfying precision to it. The pattern gives you a defined moment. A specific candle forms, and that's your cue. For traders who are trying to find structure in a market that often feels chaotic, that kind of clarity is genuinely appealing. And to be clear, this approach isn't careless or naive. It's grounded in real market logic. The problem isn't where the idea starts, it's where it stops. The structural flaw in treating a candlestick pattern as a standalone signal is that it carries no information about the environment in which it forms. A hammer tells you what happened during one session. It indicates that buyers rejected lower prices during that period. What it does not tell you is whether the broader trend supports a reversal. It doesn't tell you whether price is near a structural significant level or drifting in the middle of a range. It doesn't tell you whether momentum is aligned with the reversal the pattern is suggesting or running in the opposite direction. And without that surrounding context, you're making a decision based on one piece of information that was never designed to stand alone. The location problem is particularly important here. A hammer and a hanging man look nearly identical as candles. What separates them entirely is context. The hammer appears at the bottom of a sell-off and suggests a bullish reversal. The hanging man appears at the top of a rally and suggests a bearish reversal. Same shape, opposite meaning, because location defines what the pattern is actually communicating. If you're pattern spotting without a clear read on where price has come from and where it is in the larger structure, you're stripping the context that makes the pattern meaningful in the first place. There's also a frequency problem. On any active chart, you'll find candles that resemble reversal patterns constantly. Not all of them are meaningful. The patterns that carry weight are the ones that form at significant locations, after extended moves, near levels where the market has previously reacted, where there is a structural reason for price to reconsider its direction. A doji in the middle of a sideways range is very different from a doji at the peak of a multi-week trend move. The shape is the same, the significance is not. When I see a candle pattern on the chart, I'm not asking whether it's valid. I'm asking whether it's adding to a picture I've already started building. That's the key difference in framing. The pattern isn't the starting point of the analysis. It's one piece of evidence within an analysis that's already underway. By the time a meaningful candlestick pattern draws my attention, I've already identified the trend direction. I already know where the significant levels are, where price has previously reversed or stalled. I already have a directional bias based on what the broader structure is telling me. What the candlestick then does is either support or challenge that existing view. A bearish reversal candle forming right at a resistance level I've already been watching, that's two things telling the same story. The structure identified a level worth watching. The candlestick is telling me that price is responding to that level right now. Together, those two inputs are more meaningful than either one is on its own. I also use the TSI, the true strength indicator, as a momentum layer. When a bearish candle reversal pattern aligns with a bearish TSI divergence, that's a third input pointing to the same direction. Each layer of confirmation adds weight to the overall picture. The professional framing is always about convergence. How many separate inputs are telling the same story? A candlestick pattern is one potential input, and on its own, it raises a question. Surrounded by supporting evidence, it helps answer one. The pattern to signal approach keeps circulating for structural reasons unrelated to trader incompetence. First, candlestick patterns are taught visually. You learn what a hammer looks like and what it means, and the natural next step is to look for it and act on it. The educational format itself encourages a pattern recognition to action pipeline. The layer of contextual analysis that should sit between recognition and action often gets left out. Not because it's hidden, but because it's harder to teach in a visual format and harder to demonstrate with simple examples. Second, the approach sometimes works. In strongly trending markets, reversal patterns forming in the direction of a pullback within a trend can produce clean, successful outcomes. And if you catch a few of those early on, the approach gets reinforced. It's only over time, across a wider range of market conditions, that the inconsistency becomes apparent. Third, candlestick patterns are visible on every time frame and on every chart, and that accessibility makes them feel universal. But a pattern that appears frequently can also appear in conditions where it carries very little actual significance. Frequency isn't the same as reliability. And finally, the patterns are genuinely grounded in market psychology. The underlying logic is sound. Rejection at an extreme does mean something, and that real grounding makes it easy to believe the pattern alone is sufficient when in fact the pattern is just one expression of a broader analytical picture that still needs to be built. In position trading timeframes, candlestick patterns belong to a specific, well-defined role. They're alerts. They draw your attention to a moment where the market may be reconsidering its direction. What you do with that alert depends entirely on what the rest of your analysis is telling you. The first question I ask when I see a pattern is, where is this forming? A reversal candle at the end of a sustained multi-week move right at a level I've already identified as structurally significant, that's worth paying attention to. The same candle forming in the middle of a directionless market away from any meaningful level, that's background noise. The second question is, what does the next candle do? Confirmation matters enormously at higher time frames. A hammer suggests a potential bullish reversal. The candle that follows it either confirms that suggestion or doesn't. I'm not acting on the pattern before the market has had a chance to start validating it. The third question is, what is my momentum tool saying? When the candlestick pattern and the TSI are aligned, when a bullish reversal candle coincides with a TSI that's beginning to shift from bearish to neutral or positive, that alignment is meaningful. When they're not aligned, I treat the pattern with more skepticism. What I'm describing to you is a layered process. Trend, structure, candlestick signal, momentum confirmation. Each layer adds to the picture. The candlestick is one layer, and a genuinely useful one, but only when the other layer is already in place. Candlestick patterns are one of the oldest tools in technical analysis. They've been used for centuries because they're grounded in something real. The behavior of buyers and sellers expressed through price movements over a defined period. But that real grounding can also make it easy to overestimate what they can tell you on their own. A single candle carries information about one session. It doesn't carry information about the trend, the structure, the momentum environment, or whether the location is meaningful. Those things have to come from elsewhere in your analysis. When candle patterns are used correctly as one layer inside a multi-layer framework, they add genuine value, they sharpen your attention. They give you a visual read on what price is doing at a specific moment in a specific location. And when they align with everything else you're already seeing, They add weight to a directional view you've already built. The discipline is in building that view first, not reacting to a shape on a chart, but constructing a picture where the candlestick is one meaningful piece among several. The complete article for this video, 1 Candle Japanese Candlestick Patterns, 5 You Must Know, is available on positionforex.com and linked in the description. It covers all 5 reversal patterns, the Marubozu continuation candle, the psychology behind each, and how to integrate them with chart structure, support and resistance, and momentum analysis for a complete analytical picture. If you want the full written reference to go alongside what we discussed here, that's where to find it. And until next time, best to your trading.